it's clear regulation is definitely a burden causing the home affordability crisis. Hello everyone, I'm Seth, this is Acquired Salary. In today's video, I'm going to discuss why Americans can't find starter homes. To do that, I'm going to react to CNBC's piece on it, as well as stick around to the end where I'll run through some calculations to help you determine how much home you can afford. Before we get into it though, if you're new here, welcome. I'd greatly appreciate if you drop a like on the video because it is support like this that helps to grow Acquired Salary's reach. With that, let's jump into things.
Starter homes are disappearing from the United States. In the early 1980s, as many as 40% of the new homes built were considered entry-level. By 2023, just 9% fit the criteria.
And a lot of this is due to incentives with builders. Builders make more money on bigger homes, so if they're looking for a higher return on investment, they're going to build bigger homes and target a more luxury market.
Another 20 years, and literally no young person will be able to afford to purchase a home, period.
I would almost argue, based on the numbers I'm going to go over at the end of the video, that virtually no young Americans at this point in time can afford a home.
While a slowdown is mounting in the home building industry, which could contribute to the ongoing decline of the starter home.
Both housing starts and building permits, which are an indicator of future construction, have slowed down this fall, and it's not just seasonal.
There are over 3 million potential first-time home buyers in the country. They're up against high home prices that keep rising.
What you're starting to see are...
It's interesting here, this map you can see in Austin, Texas, Northport, Florida. These prices are going down. I suspect this is probably a supply and demand problem, or not problem per se, but you've seen increasing amounts of supply in Austin, Texas, because there have been a lot of builders there because it's been a hot market, and that explains why these prices are neutral or slightly down.
Mini price bubblettes in markets that are an hour, 2 to 3 hours from major metropolitan cities.
It is such an unusual market because we have an all-time low of first-time home buyers, but an all-time high of all cash buyers.
So where did all the starter homes go?
I'm really curious on how they account for all cash buyers, because I know when I was first shopping for my home, there were companies that would essentially, you take out a mortgage with this company and then they pay for the home in all cash. So is that being accounted for? Is that being considered an all cash purchase? If so, it is increasing the accounting for all cash buyers, even though it might not necessarily be realistic because you're still having a mortgage with the company that's paying in all cash.
A starter home is typically modest in size and price.
It's the most affordable home in any market. If you're in the Midwest, maybe it's in the $100,000 range. If you're in California, a starter home might be in the $400,000 range.
That's
To
absurd.
me, a starter home used to be a smaller condo, a smaller space, and someone would upgrade. Maybe after 5 years as they get married or have a family and want to move. But now we're actually seeing that most people are buying their first home as a single family residence and really planning on staying in place.
America's home builders are making fewer of these kinds of units.
If you look at the
Exactly what I
number
said.
of single-family starter homes, those defined as being 1,400 square feet or smaller, we used to supply anywhere between 400 and 500,000 units a year.
Over the past decade, builders have put up less than 100,000 homes each year.
Really, by far, the number one reason is the increasing difficulty that many builders have in dealing with zoning regulations.
Zoning laws are set.
Zoning laws are definitely a contributing factor to the supply of starter homes being reduced. However, it's also, again, as I mentioned at the beginning of the video, incentives. They make more money on bigger homes.
At the local level. These laws can determine the size of each lot in a neighborhood. They can also specify how far a structure is set back from the property line, how tall it is, or how many units are on site. In many cases, these laws create an opportunity for local residents to challenge new development. The residents often raise concerns, like overcrowding of schools and wear and tear on local roads.
A lot of this has to do with density restrictions within local communities. They may not want a townhouse or a condo community coming in, but they absolutely will welcome a single family community.
Zoning codes are found all around the country. The most restrictive ones are often found in major cities.
Many
Which is often where you see some of the highest prices.
builders are not leaving money on the table. They are just simply unable to build, or it's become so expensive to build that they can only build high-end single-family and high-end multifamily.
Given the high price of land, labor, materials, it's very difficult for big home builders to build the entry-level homes. There are a couple who specialize, like D.R. Horton, which has an express homes division, which specializes in starter homes. But for medium-sized builders, it's just very expensive in order to pencil all the costs they have and make it affordable to that lower-end buyer.
And again, that's just margin protection for the home builders.
As a result, home builders and first-time buyers are targeting further-flung locations.
We've definitely seen a trend toward purchasing a home further from the urban core. So you do see a lot of new construction in suburbia and exurbia.
Home values are now rising most rapidly in low-density and rural areas. Experts say that relaxing these codes could lead to higher levels of home building and preserve affordability.
For example, in San Antonio, there's some builders that are building sub 1,000 square feet, single-family detached homes, right? Which would have been almost unthinkable just a few years ago. So the market is reacting, but its response mechanism is really limited because of the rules of the game.
Some areas with less restrictive zoning codes are welcoming many newcomers.
And again, we saw Austin isn't San Antonio, so take this with a grain of salt, but San Antonio being one of the less restrictive zoning codes can help explain why there's potentially lower prices in Texas, because there's less restrictions, it's easier to build those small homes, and there's more supply, which is going to therefore be matched by demand, and the prices are going to be lower.
Experts say that more dense forms of housing could help first-time buyers, particularly in crowded areas.
We do know that local communities are trying to address the lack of housing inventory in pretty unique ways. So accessory dwelling units is certainly a popular approach right now. That's one solution, but I think we need to be looking at adaptive reuse as well. So looking at vacant hotel motels, looking at vacant residential malls, and how do we bring residential housing units into those areas?
Yeah, and that's CNBC also has a piece on how they're repurposing malls to increase the number of housing units available that are going to be more entry level in terms of expense.
Much of the new construction since 2020 is in luxury apartments, with units that are not for sale.
The recent boom in multifamily construction has been on the higher luxury end, but it's easier for multifamily developers to get in and pencil that many apartments because they're renting them, and rents have been very high.
Finances are a big barrier for first-time buyers. The premium...
We will definitely get into the finances at the end of this video, but you can just see here, rent payments are rising, but so are mortgage payments. And when you consider all the responsibility and additional costs that comes with home ownership, it is just easier to rent. You have less responsibility. You're less liable for if something goes wrong, like your water heater breaks. That's on your landlord to replace, not on you.
Paid to buy a home has increased sharply relative to renting over the past decade. The increases in home prices have also outpaced increases in wages.
And if you think of it in terms of a business perspective, if the cost of goods you're selling is increasing, or the cost of goods, the cost to manufacture something increases, but you don't have the pricing power, that's margin compression. And this is what we're seeing here. It's margin compression, making it so that fewer and fewer people can actually afford homes.
As a result, home sales are down across many markets, and the median age of the typical first-time home buyer has climbed to 38. That's up from
crazy.
age 29 in 1981.
Just thinking about all of the headwinds that a 30-year-old may have, like student loan debt and car loans and credit card debt, and then they have rising rent. And
so student loans is obviously going to be a huge contributing factor, but not everybody in the United States has a college degree, and therefore they don't all have student loans. But then when it comes to car payments, Americans just in general are not taught the proper finance and what you can actually afford in terms of cars. So in order to increase the likelihood that you're going to be able to afford a home, I highly recommend, or at least I was recommended, and I follow the 23-8. So if you're going to buy a new car, well, you shouldn't be buying a new car because it's just instantly going to depreciate. But if you're in the market, you want to put 20% down on your car. You want to have a 3-year loan term, no longer than 3 years, and it should theoretically take less than 8% of your income. Personally, I don't think you should have a car payment if you're making less than 6 figures. Even if you are making 6 figures, if you have a car that runs and drives and gets you to where you need to go, why justify spending that money on a car payment when you could save for a home?
so keeping that all in mind, it's hard to save for a down payment when housing affordability is really out of reach.
The problem is you have the most demand on the low end of the market because affordability is so rough right now, but you also have the least supply on the low end of the market.
The average...
Again, because there's such high demand, the people that can just make it work will jump into a home, and that keeps supply down of the cheap homes.
price of homes has increased rapidly too. Nationwide, home prices have climbed over 52% between January 2020 and October 2024. Adding to the burden, mortgage rates have returned to their standard historical range, near 7%. Homeowners with a mortgage are paying 29% more than they would if they rented the same house. Dynamics like that are shutting out all but the highest income Americans out of the market, at least on average.
We're seeing first-time home buyers come into the market using inheritance, using 401k or stocks, cashing those out, combining all of these resources, and actually making an all-cash purchase.
Investors are buying homes.
I don't think they're making all cash purchases, especially if you're 38. Some of the data that I'll get into a little bit later does not show that 38-year-olds or people in that age range have enough to purchase a home in all cash.
Homes too. The economists saw their shares jump to an all-time high in 2024. Still, they make up a tiny fraction of the overall housing stock.
The issue of large-scale investors is really not an issue. If you look at their share of the market, it's only 1% to 2%. However, if you look within fast-growing markets, particularly those that are affordable, and in the South, those entities are making it a little bit more difficult for buyers to purchase. Having said all that, if there was a normal amount of supply and we didn't have the shortage, this would not be really an issue.
With elevated prices on the market, today's buyers may need to rely on outside help to finance a home.
I think it's increasingly difficult to buy that first home if you don't have help. You know, in a more affordable market, it's $400,000. That means you have to come up with $80,000 in down payment if you assume the typical conventional loan. That's really difficult.
But if you're a first-time home buyer, you don't have to go down the conventional loan route, and you don't have to have that 20% down payment. And it's really a individual calculation that you have to do in terms of how much is the market appreciating per year on average. And yes, past performance is not indicative of future performance. However, you can kind of make some assumptions that if you're in a higher appreciation market, that higher appreciation might stick around for a little bit longer unless there's been some dramatic change in industry and developments going on in that local area. So you can get into a home with less than a 20% down payment. You can pay private mortgage insurance for a few years or 6 months, a year, depending on how fast you appreciate, and then you can refinance and get rid of that private mortgage insurance. And if you refinance away your private mortgage insurance, your payment's going to go down. And at this point in time, there's the potential that in the time it takes you to get to that point where you can refinance and get rid of your private mortgage insurance, you'll also have a lower interest rate depending on how things go with the economy.
To come up with that down payment. So we do see in the data increasingly more consumers getting help, whether that's from their parents or from down payment assistance programs.
There are over 2,400 down payment assistance programs nationwide. Depending on your income and where you live, the aid can be substantial.
I haven't purchased a home yet, and I've been in the process of purchasing a home. But being in this process, I definitely have more of a optimistic, perspective with home buying now. And I just talked to a realtor here, and she even told me that you are able to purchase a home even with a credit score of 500 and something. So I think it's just a matter of taking the initiative and knowing that you can be a homeowner.
Regulation at all levels of government affect how homes are built. Experts say they're holding back new construction.
This crisis is worsened by various factors, including rising construction costs, regulatory burdens, and limited availability of buildable land.
There's definitely excessive regulation, a lot of inefficient local zoning.
The zoning codes really originated nearly a century ago, and it made sense at the time. However, since then, there's been an increasing thicket of layers that have made it increasingly difficult for builders. This is sort of the concern, unfortunately, with policy, is sometimes you have to think about in advance things that can go wrong. So think about zoning. It made sense in the 1900s. It began in New York City. It made sense if you needed meatpacking plants to be a little bit away from residential areas. But you take that to an extreme and out of New York City and into middle America, and then it causes problems.
Regulation at this point can make
I think it's any video or article on this topic that digs into the regulations. It's clear regulation is definitely a burden causing the home affordability crisis, and I think it's clear we've identified the problem, yet nothing seems to be done about it at this point. So action needs to be taken by policymakers to change these regulations and rules so that we can actually make homes more affordable so that people can actually obtain the American dream.
up 25% of the builder's cost to build that home, and there is a lot of talk of deregulation, especially under the new Trump administration.
Until more housing is built, prices are expected to keep marching upward quickly.
The willingness and desire for homeownership amongst renters, particularly younger renters under the age of 35, is very high. However, the problem is the obstacles are also just as high.
Yeah, so speaking about obstacles, I'm going to get into some of the data, but Before we go on any further, if you're liking what you're hearing, please share this video with a friend or someone that might benefit from my perspectives. It's word of mouth referrals like this that help to grow Acquired Salaries Reach so that we can continue to give you free tools, information, and perspectives to help you live the life that you want. So diving into some of the data, this is Redfin's data center. This is just weekly housing market data. New listing median price or median sale price is probably going to be the more accurate data. From that standpoint, at the end of 2024, the average home price was $373,475. Plugging that into a mortgage calculator, assuming a 20% down payment, gets you to a monthly payment of an annual payment of $28,905, or a $2,400 a month payment. That's quite a bit, pretty steep. And if we consider the average weekly or median weekly earnings, we can go here posted by the Bureau of Labor Statistics. Median earnings for the American worker is $1,165. Multiplying that by 12, that's $60,000 a year. And when it comes to what you can actually take out on a mortgage, you can take out at max a 50% debt to income ratio. So assuming no debt, you can afford a monthly payment of just about $30,000, which kind of paints this picture to be not so great. It's not necessarily, it's potentially just in reach. But again, that's assuming a 20% down payment. So what is American savings looking like this year by bank rate? Under the age of 35, the median bank account balance is $5,400. So you're probably not going to have that $80,000 down payment. Plugging this in, a $5,400 down payment, we come down to a $34,000 annual payment, which makes it to where this is unaffordable, even with a 50% debt to income ratio, assuming you don't have any other debts. So I go to NerdWallet and how much home can I afford? Assuming the median earnings applies to you, $60,580 a month with no additional debts. This is saying that you could probably afford $171,000 to purchase a home, which in any major metropolitan area pretty much doesn't exist. However, that's not the end of it. If we go into the average debt service that the younger generation has, this year by CBS News shows that Gen Zers have the lowest average monthly debt, but it's at $645. So if you have $645, that's going to be considered additional debt that is taken into consideration with your debt to income ratio, which again lowers how much home you can afford. And this year, the NerdWallet calculation is doing a 36% debt to income ratio, which is following the good finance rules of not overextending yourself. Because if you're at a 50% debt to income ratio, you might be able to get into a house, but you're going to be house poor. You're not going to be able to afford pretty much anything else. So with your average monthly debt payment and the average income, you're looking at the home affordability of $75,000, which is certainly unaffordable, especially for the younger generation. I'm curious, what do you think? Please share your thoughts and comments in the comment section below. If you've made it this far into the video, you may as well subscribe to the channel so you don't miss out on future videos just like this one. Until next time, thank you.